Hello and welcome to Livewire C-Suite reporting season coverage. My name is Kerry and joining me today is Inder Singh, the CFO of QBE Insurance. Inder, it's good to see you and thanks for joining us.
Thank you, Kerry. Great to be here.
Great, we've got a lot to unpack with QBE delivering a solid set of numbers for the first half last Friday, but it looked like the market wanted a little more. So could you start us off with some of the key numbers that we need to know about?
Yeah, look, a fantastic result. Very happy with it. A few of the key numbers, growth was very impressive. So we grew the business 8% year on year, which is very strong. We've got a wonderfully diversified business around the world, with some really interesting growth opportunities, particularly in the UK, the Lloyd's market, and in the US market. So the business is growing strongly. Profit was almost $1 billion for the half, which was up 30% compared to the last comparative period. So again, very strong growth, but also coming quite evenly between our investment result and our underwriting result. And within the underwriting result, each of our divisions, so in Australia, international, and the US, all contributed to that result. So we're very happy with that. And I guess the last number is the return on equity, at 19% for a financial services company. That's a very strong result.
Great, sounds like the business is firing on all cylinders. At a time where industry estimates show that it was the most expensive first half for insurers in over a decade. I think your catastrophe costs came in at $480 million, which is comfortably in your guidance or allowance of $539 million. How did that come about?
Yeah, so it's been a lot of hard work going into making sure that, we're understanding the risks we're writing. So, we're living in a world where, these catastrophe events, every year is another record, Kerry. So, we just have to get used to that environment. We've done a lot of work in better understanding the risk, making sure we've got the right balance, making sure we're getting the right pricing for it. So if we look back the last 2.5 years, so we have beaten our catastrophe allowances the year before and the year before. So this isn't a one-off. Our cat allowance is set at what we call the 80th centile. So we should really be doing better than our allowances in 4 out of 5 years. We've done that because we think the modelling is still catching up a little bit. The industry's modelling of these cat events is still catching up a little bit. And we just want to make sure, just given the volatility we've seen, that the risk settings of the organisation are set in a way that we can manage through some of these more volatile periods.
Now, speaking to an insurance company, we have to talk about your combined operating ratio. It's a number that the market watches like a hawk. And the ones that you delivered for the first half and the ones you guided for the full year, both within market expectations. Could you give me a bit more colour on these outcomes and maybe some of the risks that as we head through the second half of the year?
Yeah, so 92.8 was our first half number, and we guided to the 92.5 for the full year, which is reaffirming the guidance that we gave in February. So, we're feeling very good about the health of the company. That's a very strong underwriting margin. In terms of key risks for the second half, obviously, the world remains quite a dynamic place. As a risk-taking organisation, we've got to be conscious of many of the risks that are playing out. There's geopolitical tensions, there's tariffs, there's some conflict in parts of the world, there's changing weather patterns, etc. But we feel very confident about the risk settings of the organisation and about the second half. The two main risks, just to double click a bit on key areas. One is Q3 tends to be the North Atlantic hurricane season, so we tend to see quite a lot of cat activity in Q3, so that'll be an important one for us to watch. But again, our allowances are set in a good place, our portfolio is in a good place. The other key area is really the crop business in the US. So we have a very large business in crop insurance. The crops get planted in the first half and then they get harvested in the second half. So we've got to see how that plays out. Again, we've got a new CEO in that business, a new CFO, a new head of marketing. We've sort of reset the portfolio in that business and we're feeling pretty good heading into Q3. So plenty of risks out there, but we're managing the business with very much a lens to managing that volatility.
Now, excess capital, a bit topical, really comes down to either pursuing organic growth opportunities versus capital management, whether that's a special dividend, buybacks, or a higher payout ratio. I just wanted to get an understanding of your priorities.
Very topical question, obviously, with the market as well. I think the key thing for us is the business is growing, as I said, at 8%. We're returning 19%. So at these set of settings, every $100 that we have in terms of capital, we really should be deploying back into the business to the extent we can get these growth opportunities that can deliver those returns. Going forward, obviously, as the market changes a little bit, growth may come back a little bit. If that does, or we see that the return profile is shifting a little bit, we'll be very thoughtful around capital management. Our dividend payout at the moment is 50%. We feel pretty good about that. But, there's a world in which, depending on how things play out over the next couple of years, that we could deliver a sensible level of growth, a decent payout, but also, have some capital management sitting alongside that.
I think there was a metric that the market might have been surprised by, which is the deceleration in premium rate increases. Great for consumers, but you did 4.5% in the first half, down from 6.7% this time last year, and 10.2% in the first half of 2023. So, Inder, simply put, is the golden era of pricing power for insurers coming to an end?
I wouldn't really describe it as the golden age per se. I think the insurers, when we look back 3, 4, 5 years, have really struggled to get a handle on the risk, given the dynamic nature of the landscape we're working in. So, we've done a lot of work to get a better handle on that risk. Profitability has improved across the sectors, and we just want to make sure that the year-on-year rate increase we're looking for is reflective of the claims environment we're in. And in some classes of business, and again, we've been very clear in highlighting this through our disclosure, that in some parts of the business where profitability has been very high and rate increases have been well north of 50% when you look back the last number of years, the market is giving back some rate. And, that's okay. It's not going to affect the group's margin overall meaningfully at this stage. So, look, it's a metric that the market has focused on. I think it's one of the inputs in terms of thinking about margin for the organization going forward. But we think, when we look at rate versus inflation more broadly across 80% of the business, it's in good health.
Another factor that might be placing a bit of downward pressure on the business is bond yields. Now, obviously, as an insurer, you rely on that for investment income, and yields are widely expected to kind of fall as inflation returns to target and as central banks cut interest rates, kind of like the RBA on Tuesday. So, how are you positioned for this headwind?
The risk settings from an investment portfolio point of view remain very stable. We've got $34 odd billion in investments that are diversified really well across the world. We have a big focus around fixed income. And so, yes, the yield outlook is important. But, we see a level of moderation that's already priced into bond prices going forward. If we look back a year or two, people have been talking about interest rate cuts for a long time. Inflation has proven to be a lot stickier. We are seeing some themes around, things like deglobalization, shifting supply chains. So we see a level of inflation, that's going to be a little bit more persistent, right? Yes, it might moderate, and I think the rate settings will reflect that. So, from our point of view, the investment portfolio is doing a wonderful job in contributing to the returns of the company. If rates come back a little bit, that's perfectly fine. If we put that together with our underwriting result, the company has still got very strong returns and earnings profile going forward.
And finally, Inder, AI is all the rage right now. How is this new technology disrupting the insurance sector or insurance space, and how do you use it on a day-to-day basis?
Yeah, look, it's a big opportunity. The technology has some fantastic application in the world of insurance. We deal with a lot of unstructured data. So when we look at our claims staff or our underwriting staff, they're wrestling to get a good handle on broker submissions or claim submissions that are coming in very unstructured ways. So for us to start to use the technology in helping improve the value of the work that our people are doing is immense. So we've made a good start, over the last 18 months to 2 years. We've got a number of very successful deployments, one of those being in North America and our cyber business, where we've been able to streamline our submission process for submissions coming in from brokers, get through a lot of business. We're doing a similar implementation in our accident health business in North America. So we've got a couple of really powerful use cases coming up. I think the challenge for us is going to be, how do we accelerate, how do we scale, and how we embed the use of this type of technology in what's, a very important sort of regulatory risk setting for us, right? Like, we've got to make sure that the models actually work, that they're accurate, that they're giving us the right outcomes, that we've got the human in the loop to kind of assess that. So some challenges ahead in terms of adoption, but I think the potential is immense, and we're very much looking forward to accelerating the adoption of it.
Inder, thanks for sitting down with Livewire Markets and walking us through your first half results. Well done, and I look forward to seeing you for the full year.
Thank you, Kerry. Thank you for having us.
If you enjoyed that C-Suite interview, give us a like, and don't forget to follow our YouTube channel, where we're dropping great content every single week.